Welcome to the weekly update, where I'll go over the action in the market for the week of July 15th through the 19th. And then we'll see how things look for the week of July 22nd through the 26th. Had an interesting week. Everybody just assumed the market was just going to go up and up and up, and the small caps and the mid caps were just going to keep going up. And the week started out that way, but it ended up not finishing that way. So let's look at the charts and see where things look right now. Before I get started, I do a video each day, and I have a graphic after this to show you that. And that's where I provide commentary and analysis that you might find helpful, even if you're a longer-term investor. We started to see these problems creeping up day by day by day before they actually turned into something. And watching the daily videos can really help you with that. I do have a PDF that's available in the description below every video that I post. There are pivot points on the YouTube community tab. These not only apply to the whole month, and it's updated each day with each day's bar, but there are intraday pivot points that are really quite helpful to provide support or resistance. I do have a private Facebook group, not really active there, but you're welcome to join if you want to have some back and forth that way. And they must have been running some webinars or something. I'm just going around playing whack-a-mole again, having to get rid of these comments from these social media experts who feel that they need to leave comments, especially on Rumble. I'm really not getting any on YouTube right now. And I do post on YouTube and Rumble. Sometimes I may have a trouble on one platform, but not any problems on the other one. Here is the link to the Rumble channel. I do have a program that is still free. You're welcome to check that out. There's a link in the description below this video that will take you to that website. There's also a link that can take you to some videos that talk more about the program. Additionally, you can send me an email at this address if you have questions or if you want to talk about this. And this is how I do the videos each week. I do a video each day, and then all the videos around the outside, including this one, are meant to be supplemental. They all tie in to the daily video. Another YouTube channel that you might find helpful, especially from a long-term perspective, is Shavaco Capital. And then also another interesting YouTube channel is Bob Kindle, who operates a channel called the Kindle Report. I don't pass this along all that lightly. There's a lot of garbage out there. In fact, most of it is garbage. But these are a couple of channels that I have found to be pretty useful with folks that really know what they're talking about. Let's go back and talk about this week's session. So for the week, we were down 1.97%, and we were above average with volume. When we look at the daily charts, we've turned negative now in the short term. We dropped below the 20-period moving average. We're showing weakness in the intermediate term, but we are still above the 50-period moving average. That's my definition. So we're showing some weakness. We don't know if this is going to last a short period of time or actually develop into something. Nobody does, even though everybody likes to speculate about that. And it's, at least in the upcoming week, we're going to get some inflation information. We're going to have the first reading of GDP, and we're also going to get the core PCE on Friday. So Thursday and Friday are pretty influential days. Right now, it just looks like the Fed is keeping rates higher for longer. And the market is pretty much anticipating that there's going to be a rate cut at the September 18th meeting. Of course, there are signs that will suggest that we might go into a recession. There are other signs that suggest we don't. And periodically, I do updates on the website just showing, okay, what are the charts looking like to suggest that we might go into a recession, and other charts that suggest we won't. And that's a debate that goes back and forth as well. Our trend is still strengthening. We're starting to roll over negative in the short term on the daily charts. We're showing weakness, and any more follow-through weakness might turn it negative in the intermediate term. But here with the long-term trend, we're still positive. The green line is above the red line, but with the down week, it is now declining, and I'll show you that chart. Here are some bullet points. Stocks did decline, but the broader market improved. That's because we saw weakness in the mega cap stocks and in the semiconductor stocks. They were down on the week, where other stocks that have been lagging behind saw some more interest in buying. And there were reports that came out, and this is kind of what was the catalyst that started things, especially midweek or so. Some reports say that the Biden administration is considering tightening export restrictions to China. And then, not to be outdone, former President Trump said, well, Taiwan should be paying the U.S. to defend it, because officially we do defend Taiwan. And he also said, how come you're making all the semiconductors in Taiwan? We used to make them in America, and then we exported those over to Taiwan. What about bringing them back to the U.S.? So we have both sides are kind of speaking about what's happening, and that it had a negative impact on the market. Right now at this time, now this can always change, but there is speculation that Trump is likely to win the presidential election. And it doesn't matter if you agree or disagree with that. I'm just going with what the market thinks is going to happen. And you probably have heard about this many times, that a week ago, there was a failed assassination attempt, and he got hit in the ear. And of course, there's people that say, no, it didn't really happen. It was just glass or whatever. Anyway, this has bolstered his popularity. And plus, this past week, we had the Republican National Convention, which also, that no matter, a month from now will be the Democratic National Convention, and they'll see a boost up in approval ratings and popularity as well. Also, there's a speculation that if Trump ends up winning, he would be more market friendly because he pushes for deregulation. And when he was president before, he did introduce a lot of deregulations and lowering corporate tax rates. And there are cuts that are still in place right now that have not been repealed, at least to this point. And the market likes that. And this was stated at the Republican National Convention. Also, you probably know this already, but J.D. Vance was nominated as the vice presidential running mate. So it's the Trump-Vance ticket now. The political news was taken as positive, and at least earlier in the week, it contributed to the ongoing rotation. And we're seeing some money going into the small caps, the mid caps, cyclical stocks. They cycle with the economy, and even value stocks. We've been seeing growth really underperforming, and I'll show you in the charts. But then we got later in the week, and it's like everybody was just starting to jump on board, and that's usually about the time when the market reverses. But even on the week, mega caps and growth stocks ended up being down, and those have been the real up areas most of 2024. Regional banks, this is an area that we've been keeping an eye on in case there's any problems. They were up 1.7%. And later on, I'll show you the KRE, which is the regional banking ETF. It was up 7.5% on the week. And there's this expectation that the Fed's going to lower rates. Right now, the market thinks it will be in September. And this has also really spurred some buying interest, especially in bank stocks, as well as home builders. And home builders were up 5.3%. They like interest rates going down. And then earnings were taken as positive. We did get reports from Bank of America, United Health, Goldman Sachs, Taiwan Semiconductor, and Johnson & Johnson, as well as SLB. These are big influential companies, and we're just getting started with earnings. Then on Friday, and you probably heard about this as well, there was a global IT outage. What happened was CrowdStrike, they did an update to their software that had a flaw in it, and that ended up getting more or less merged with Microsoft Windows, and that caused a lot of problems. And then earnings reports will increase. We're just getting started with the earnings report season. So for the week, the Dow was up 0.7%, and we were down with the NASDAQ, and I have to turn on my pointer here. We were down 3.6% for the NASDAQ. Again, these are more growth areas. The S&P was down just under 2%, and the small caps were up 1.7%. And this is the chart that I've been showing. We're still possibly coming into this where the blue line is still going down with inflation going down. The reason I'm showing this is look at what happened after that. Something may end up playing out in a similar fashion going forward. We don't know that for sure, but it has been tracking what has happened from 1966 up to 1982. And a lot of people are just, inflation is going to go through the roof. We're going to have stagflation. We're going to have hyperinflation. And that may end up happening. We won't know that until we actually evaluate things and see where we're at on a day-by-day and week-by-week basis. Also, we did close at 4.24% with the 10-year yield, which is above the 4.02%. So that's still biting into corporate profits. This hasn't been updated. We're keeping an eye on this because it's the employment situation that it was kind of the last area to show weakness, and it's justifying the Fed keeping rates higher for longer. Well, when you're employed over 6 months, unemployed over 6 months, they track that. But this is only updated once a month. So the last time we saw this report, it had been going up. So we're going to want to keep an eye on this. We are still seeing earnings looking good going forward, both on a projection basis from Morgan Stanley as well as the consensus basis. And we're seeing an awful lot of money just flying into small caps right now because that became the cool trade to do. Well, since a lot of money's flowing in, now we're starting to see them fall. And then looking, there's no rotation from U.S. to international equities. This just means that the U.S. stock market still continues to be the strongest. And then this is something that I do follow, and I go through this as well in the intermarket analysis video. We're not there yet, but we're still inverted with the 10-year to the 2-year yield curve. When we go back above this and we start to look normal again, then that's when we start to say, okay, is a recession going to happen? And we're usually looking at about 5 to 6 months after that on an average basis. It can be shorter than that. It can be longer than that. This is some projections for core PCE as well as CPI. We're going to get PCE, the core PCE, coming out on Friday. And for right now, they're still projecting that both from CPI and PCE that inflation is going to fall. And then this happens typically on a historical basis. What happens before the Fed starts cutting rates and then what ends up happening after that? And I'll just pause this and look this over to see if that's of interest to you at all. And then global growth expectations are down, but July was more optimistic of a soft landing. So we have been coming down here with this reading that they're not necessarily expecting a stronger economy, but the S&P is still going up, but it is still more optimistic than it has been in the past. FactSet had a couple of postings here. Analysts believe that the S&P will close above 6,000 in the next 12 months. Okay, fine. But this is just what they're looking at projecting going out into the future. And then this is bottom up, which means you're looking at actual stocks and then what the closing price will be. And they're projecting that will also rise. And then we had another post here since we're coming into earnings season, and I'm only going to read the parts in red. It says, right as of Friday, 14% of S&P 500 companies have reported. 80% of that, 14%, they're above estimates. Okay, when you take it all together, this is kind of skewed a little bit because they're 5.5% above estimates, but it's not, it's still using old numbers to come up with the rest of the 503 companies. All right, here is an intraday chart where we were looking pretty good here on Monday. We did see, now I will say I was really concerned on an intraday basis when I saw the late day sell-off on Friday, but we were still looking fairly positive. Then on Monday, we were really going up and we set a new all-time intraday high, but then we started to come off of that and the bounce actually failed and we ended up closing at the low for the session. That was a real big warning sign to me. We weren't seeing late day strength coming into the market. If anything, we were seeing late day weakness. Well, then we kind of just drifted a little bit up on Tuesday. So it looks like, okay, maybe things are getting better. Then this news hit about possible problems, at least on a business level basis, between Taiwan and the US, and rhetoric coming out from both sides in the presidential election. And the futures went negative way before we even opened. And that's where we saw the gap down. But we didn't see much movement in Wednesday's session. But then things started to turn even more negative. We actually looked to bounce and then really started to go down in Thursday's session. We were flat in Friday's session and then ended up closing pretty much at the low. So earlier in the week, there were warning signs, and I was pointing these out in the daily videos, but we weren't really falling apart. Later in the week is when things really started to go down. So for the week, and this is just the 5 trading days, we had the small caps were up and the Dow was up. All of the other indexes, the NYSE, the mid caps, S&P, NASDAQ, and NASDAQ 100, they were all down. But just for the 5 trading days, But if you go back to the beginning of the year, now we have the NASDAQ and NASDAQ 100 that are still up the most, with the S&P in third place. And all of the other indexes are now positive on the year. Looking at the sectors, we had a down week, so that's how I sort this. We had the tech sector down the most, and that's been the darling area that everyone seems to love. Discretionary was also hit. Utilities were down, and communication. Communication and tech, these have been the stronger areas, where we saw energy and real estate up, and the financial sector was also up. Staples, which is a more defensive area that we're keeping an eye on, it was also positive on the week. Now, I rearrange it in a different way here. What's the best looking sector right now? Well, tech had been in first place for a long time, but now we have the financial sector. But none of these are in the 90s. Okay, they're looking pretty good with financials and utilities and energy, but then communication has really dropped off, where the weaker looking areas are staples, discretionary. Tech is now down here, and materials, and then healthcare is still looking the weakest, even though it's improving. So here are the sectors just for the week, where we had tech down and all the other 10 sectors out of the 11 were up. This is going back to the beginning of the year. We still have communication and tech that are positive. All the other sectors, at least the way I measure it here, going back to the beginning of 2024, are negative. This is looking at the relative rotation graph, where we're seeing things really starting to show some weakness in here, where XLK, that's tech, it's still looking strong. Remember, this goes over the last year, where we're seeing a lot of weakness in these other areas, but real estate and discretionary are showing some signs of improvement. And then here's breaking those same things down, where we have tech looking the best, with real estate and discretionary looking pretty good. Utilities are kind of neutral right now. And then all these other sectors over the last year are actually looking more negative. And we look at the major indexes, or we still show the NASDAQ 100 and the S&P 100 doing the best. The S&P is doing quite well. Utilities had been strong, but you see how that's really trailing off and showing some weakness, where we have the mid caps and the small caps. They're going to have to do a lot more than the few updates we've seen to this point, but then coming in really weak continue to be the transportation stocks. Okay, so here's showing how the NASDAQ, S&P 100, and S&P 500, they're doing the best. Utilities are more neutral right now because they're showing some weakness. Transportation, the Dow Jones Composite, small caps and mid caps, when compared to the Wilshire 5000, those are still negative. Looking at sentiment, and this is a chart, you know, especially during an election year, we have all these polls and surveys, and you know, okay, fine. No, whether it's an email that somebody answers or a phone call that somebody answers, I tend to look at this. Now, I don't promote betting or anything I don't bet on sports. I don't bet on politics. I don't do that kind of a thing. But I do look at this site. It's predictit.org, because these are people actually putting money on what they think will happen. And if they're willing to lay down some money to bet on something, I think that has a little bit more weight than just these surveys and even Real Clear Politics with their average. I think this is a little bit better way, but we've seen a real shift lately, where Donald Trump is still in the lead. According to this is what people are willing to bet will happen. But now we saw Joe Biden drop from second place down to third place, and now Kamala Harris is coming in second place. I'm not showing you this to try to persuade anybody one way or the other. My videos are apolitical. I don't really care. You might find this interesting, though, just from an informational perspective. So I wanted to share this with you. Then, looking at the fear and greed index, we're back to neutral. So we look at the chart where we were looking better. We were starting to go up with sentiment. Well, then we hit a couple of kind of bad days, and that's dropped us right back down. And we're actually looking more negative at this time. There's another sentiment indicator, also starting to come up a little bit, but well below. And this is more neutral as well. Here are the active asset managers for 2 weeks. They were above this 90 level. These are professional money managers. They're since starting to pull back. This is that same chart coming in at 87.94, no longer extreme. Here's the VIX, which on Thursday and Friday, this is where it really shot up. So we saw most of the upward move, where we've been seeing much lower readings with the VIX. And this is the seasonality chart, where typically coming into May, June, and July, we see the VIX tend to go lower on a seasonal basis. And then going forward from here, is when we see the VIX starting to go back up, which if this continues to go up, probably means that stocks are going down. The Ulster Index is still continuing to decline. We're actually seeing it start to pick up on the daily chart. We're also keeping an eye on the spread between risky and not as risky bonds, which seem to be okay for right now. Even though we've been coming down with the S&P, this inverted spread between risky and not as risky, this is still going up, which is good. That's more positive for the bond market. Where the VIX, again, this is also inverted, where it has now been coming down, which means the VIX has been going up. Then the latest reading from Investors Intelligence, and I'm going to be dropping this from the daily video because it only updates once a week. So I'm just going to show it here in the weekly video. It came in at 3.81%. We're getting extreme when we get above the 4 level. Then the RIDEX Bear Bull ratio. This is as of Thursday. Most folks were still anticipating that the market was going to go up. The latest reading from the American Association of Individual Investors, they were just underneath this extreme positive reading. Now that's probably going to be coming down as the market's been under pressure. This also is still looking positive, even though the black line did tick up. This means, when this is going down, that the tech sector is outperforming cash. Looking at the economy, we are going to get the first read of GDP in the upcoming week, where if you look at the Atlanta Fed GDP now estimate, we're right at about 2.5%. The top 10 estimates are about 2.25% to the upside and about 1.5 to 1.33 or so to the downside. This is what it looks like in column form, bar chart here. The takeaway that I usually say here is notice that these are still positive for right now. If we go into a recession, these are probably going, not these already, but going forward, this is likely to turn negative. And also looking at forecasts, the takeaway from this, whether you're looking at what Goldman Sachs thinks or these black diamonds, which are consensus, is that we're still looking positive going forward from here. The Chicago national financial conditions, we're still going down, and it's when we go above the black line, that's when we're nervous. This hasn't been updated since July 5th. We're a little concerned about this with the real-time SOM rule recession indicator. We get concerned if we go above the red line. So we'll be waiting at the beginning of August to see this chart update. Also, the smooth U.S. recession probability still below the black line. We get nervous if it goes above the red line. The Brave Butters, this is a quarterly update where it has come down in the most recent reading. Inflation, we're going to get some adjustments with core PCE coming out on Friday, where you can see overall we have been dropping as far as inflation. When the Fed meets on July 31st, there's a 95.9% chance that they are going to leave rates unchanged. There's still 4% of folks that think that there's going to be a rate cut, but that's not the majority for right now. And this is how it's changed. And if anything, it's becoming more likely that there's not going to be a rate change at the July 31st meeting. Now, this is where it gets interesting because there's a 94% chance that at the September 18th meeting, the Fed will cut rates 25 basis points. And that's what the market is expecting. If that ends up not happening, then things could get kind of ugly because the market is figuring that will happen. And if anything, it's getting more convinced of that all the time. Looking at the Fed balance sheet, where we look at it declining here, but it did go up in the latest reading. We look at the year-over-year change where it's going up, but here we're showing a minus sign here. So a little bit of contradiction there. Then these are the overnight reverse repurchase agreements. We want to see if this really starts to go up. It's pretty much leveled off lately, so it's not really giving us any warnings right now. Looking at breadth, now we're starting to show a little bit of weakness on the daily charts, but we're still hanging in there here on the weekly charts based on price and volume. And internally, we're still looking okay, but not great on the daily charts, where we're still going up here with the 4-week average, and the 10-week average is also going up. So longer term, the internals for the S&P are still looking fairly solid. We look at the advanced decline ratio, which it did decline, but is still above 0. And accumulation distribution, we're coming down. We're no longer getting an extreme reading as measured between the indicator and the moving average, where we're in danger of actually turning negative and dropping below the moving average on the daily chart. And this is a primary indicator. Looking at our trend, this is what I mentioned earlier here, where the ADX is still going up above its moving average. The green line is still above the red line, so we're in a positive trending environment. However, the green line is now going down. On the daily chart in the short term, the green line and the red line are meeting each other. They're kissing right now. And the green line and the red line on the intermediate term chart, they could cross fairly soon, where it's still holding up a little bit better with the weekly chart. Then we look at the Arun, the green, these are the buyers. They're pegged at the top. Sellers are pegged at the bottom. We're still getting an extreme reading with this indicator. The mass index is not generating a signal. So we look at the daily chart where we broke below this pivot point here. That was kind of an important level as we were going down. We also came down below the 20-period moving average, which I don't have on here. I do have a 50-period moving average, and we're going to be watching that if we see more weakness. And we have this S1 level and the 50-period moving average pretty much lining up with each other. So that's pretty significant support. On the bottom, we've been above average for the most part. Then looking at the Keller market model, stocks in the S&P have now turned negative in the short term. They're negative with the NASDAQ 100. These are the mega caps. These are the large caps. They're in both of these indexes, where the other areas of the market are still hanging in there. Then we look at a macro model where stocks are negative in the short term. Bonds are still negative in the long term based on price. Commodities have turned negative in the short and intermediate term, and the dollar has also turned negative in the short and intermediate term. We have not seen any changes yet with the decision point scorecard. We're still well above the midpoint of the channel, and we're actually threatening to go back up to the higher end of this channel, even though we had a decline. This is still hanging in there. We've had 4 weeks now where we've closed above this R2 level. Even though we declined on the week, we're still hanging out above this level. So we'll be watching that to see if it ends up providing support. We're still above the 50-period moving average. That's 50 weeks here. And the line is still going up, even though the S&P came down. The long-term trend still continues to be positive for the S&P. We're coming down, but we're still positive with the McClellan oscillator. And we're going up with the summation index based on price and volume. So longer term, we're not really seeing a lot of weakness, at least yet. The Swenlin trading oscillator based on price and volume did decline, but both are still above zero. The bullish percent index, even on the daily charts, this is encouraging. It's holding up better. Even as we were going down, we're not seeing a lot of weakness right now in the BPI on the daily chart, and we're still seeing strength here on the weekly chart. The momentum, though, we're starting to roll over and look negative on the daily charts, where we're still looking positive here with the PMO. The PMO based on price and volume continue to advance. But when we look at the PMOs that are rising, they're declining now, but the buy signals are still going up, and the PMOs that are above zero continue to go up. Bollinger Bands, after getting an extreme reading a week ago, we closed outside of the upper Bollinger Band here. We came back down enough, so it's no longer extreme. Here's the momentum on the weekly charts, where we're still going up with the slope and TSI. We're rolling over, but still looking positive with the MACD, PMO, and PPO. We're trying to turn up still with the tricks in the KST, which are longer term. Where if you look at this same chart on the daily version, we're starting to roll over and look negative. Shaken money flow. This has already turned negative on the daily chart. Another primary indicator. This going down is not giving us an awful lot of confidence right now, but it's still positive. The Shaken oscillator has already gone negative on the daily chart, and it's declining here on the weekly chart. The force index is extreme negative. It's dropped below zero now, where it's still positive here on the weekly chart, but it is declining. And after being extreme positive, the money flow is now declining. We had a down week, so the rate of change from 1 week to the next is negative. Going back 50 weeks, we're still above this red line, so we're not showing a lot of long-term weakness, at least yet. The RSI based on 14 weeks after being extreme is now starting to drop back down. The weekly special K chart continues to be negative. And we're coming down after being extreme with the Stochk RSI. We're declining, no longer extreme with the Williams percent R. We're declining, but still positive with the ultimate oscillator. The Vortex still has the green line on top. We're seeing a little bit more weakness here on the daily chart, but it's still positive as well. The copy curve has switched back to negative on the daily chart. It's still positive here on the weekly chart. And we're wondering, are we going to come down? This is a 10-week moving average, which equates to about a 50-period moving average. If we continue to fall, are we going to come down and hit this support level? We're still going up with the 253 equity put call ratio. When it's going down, that's more positive. The fact that it's going up is more negative longer term. And we're starting to turn back up with the VIX to the 3-month average of the VIX and taking a ratio of that. And we're still looking good here with the Heikin Ashi. We still have open candles that are going up. We're still looking good with the Kagi chart pointing up. We're still looking good with the Renko chart, and the 3-line break is also looking positive. Where we're starting to see some negative signs coming in on the daily charts. The ease of movement is still above 0 with the 14-week. That's still positive. And we're seeing the same thing on the daily point and figure chart. We had enough of a decline to have 3 zeros drawn in here. There's no longer a signal from this. This was a double top breakout generated in about the middle of May. That's now gone as things are looking a little more negative currently. When we look at the momentum, we're flattening out with the long term, starting to decline in the intermediate term, and seeing much more of a decline in the short term. The 50-day cycle, the writing's kind of going off the edge here. We're not really at a turning point according to this cycle, so who knows what will happen there. We've turned from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR, but on the daily charts, the parabolic SAR has turned negative with the dots on top. In the broad market, we're still looking okay. We've been up 100% of the time from 2020 to 2024 with a return of 4.2%. The month isn't over yet. So just looking at the S&P weekly chart, still looking pretty good here. This damage that's been done, it could be repaired. What we're wondering now is, are we going to see more weakness from here? The mid caps are finally showing some life, and the small caps are also showing a little bit of life these days. But when you look at the Dow, it set a new all-time high this past week, and it's still in an uptrend. The NASDAQ is in an uptrend, even though it declined. NASDAQ 100 declined, but is in an uptrend. Here's another chart of the QQQs. A little bit scary looking here where we have this doji looking weekly candle, which I pointed out a week ago, and now we see a decline after that. Does that mean this is the beginning of something? We don't know yet. We just want to be aware of this. The mid caps are showing some more strength, but you notice they closed well off their highs. They were up much, much more earlier in the week, and we're actually down according to the weekly chart here, where the small caps were up 2.22%, but you can see we got up as much as 6% during the week and then gave a lot of that back and closed well off the highs. Not a lot of confidence at this point. The NYSE is still in an uptrend. The Wilshire, this is a daily chart, even though it's off of its all-time high reading, is still in an uptrend. All stocks fell back, but in an uptrend here. The big software companies, not really breaking to the upside, but not really breaking down either. They're in a longer-term uptrend. The FANG index set a recent all-time high, but has since been pulling back. ARK just not really doing much these days and in a longer-term downtrend. Here is the KBW Bank Index, where it was really up solid on the week. And then we're still seeing money going into banks, which is just suggesting confidence in the banking system. This is a weekly chart of Dow theory where we set another new all-time high. We're not even close to that with the transports. So this is a Dow theory non-confirmation. And the utilities are starting to bounce back up a little bit here, but not setting all-time highs either. At the broad market here, the CRB index, this is commodities, starting to come down, but still on the weekly chart, we're in an uptrend. Oil dropping back down under 80 at 78.64. Copper has been falling back down now. That may suggest a weaker economy going forward. The dollar is still in an uptrend, both on the daily and here on the weekly chart, but we saw some weakness even though it was up on Friday. Gold really tried to break out, but then gave pretty much all those gains back and ended up being down on the week. Silver also dropping down below the 13-week moving average here and pretty much range bound. Looking at total bonds based on price, we are still positive longer term. The monthly chart of stocks to bonds is still positive. Looking at the gradual decline here that we've been seeing in interest rates, but they did spike up in Friday's session. Looking at a weekly chart here with the US and UK rates, actually showing a little bit of divergence here. One went up and one went down. We declined a little bit with German rates and a little bit here with Japanese rates. Some relative studies where we still, a lot of things are really getting hit right now. Oil, which is still doing the best, but then gold is coming down and stocks have been coming down, where the dollar's actually been holding up. Bonds based on price are still negative on the year. So a ratio between the NASDAQ 100 and the S&P 500 shows how the NASDAQ 100 is underperforming, but longer term, it's still outperforming. The S&P 100, the biggest stocks that make up the S&P 500, also seeing a pullback as the large caps have been under pressure. Growth to value pulling back where longer term, it's still in an uptrend here, but we're seeing growth getting hit right now where value is seeing some strength. And gold to S&P, just more or less dropping sideways. You would have been better off being in the S&P than getting into gold, at least to this point. And then gold against the dollar still shows that gold is trying to outperform slightly, even though it was down on this week. Bonds still are underperforming stocks even longer term. And the low volatility to S&P ratio shows that the low volatility, which are more defensive stocks, they continue to underperform even though they bounced up this past week. But we're not really seeing a shift in the overall climate. Discretionary to staples. This has been a disappointing area. It was starting to show some improvement, but has since pulled back. Energy to tech. Energy was up, tech was down, but not enough to change the overall direction of this ratio. And then longer term with the NYSE breadth thrust coming down as we're seeing some weakness. And this is not a ZWAG NYSE breadth thrust, even though we had a very high reading here. This was giving us a bit of a warning sign that maybe we're getting a little too happy, but there wasn't a corresponding low that was set before that. And then this just shows you the track record of the ZWAG breadth thrust going back to World War II. The NYSE Zohorchak method still is on a full-on buy signal. We're still looking good with our weekly chart for the S&P. Here's a further breakout where even with the decline that we saw, the chart is not necessarily falling apart, at least yet. And we're still going up with the NYSE new highs minus the new lows and then taking a 50-period moving average of that. And when we look at the same thing for the S&P 500, this is still going up for right now. So longer term, that's still positive. The NASDAQ 100 weekly chart, even though it's pulling back, is still above the trend line. And this is coming down, and the perma bears are just going to fall in love with this. We're coming down with the NASDAQ 100 to Dow ratio, but we're still above this level that they thought was the holy grail to the market falling apart. Also coming down as we've seen some weakness in the Qs and strength in the IWM, which are small caps. So this ratio is coming down, but not necessarily falling apart, at least yet. Semiconductors to the Dow, semis were under pressure. The Dow was going up, so we're seeing that ratio coming down. Then looking at the cumulative new highs, new lows for the NASDAQ, we're just kind of chopping along sideways. On the bottom is just a daily chart of the raw score. Keeping an eye on the 3-month yield, but it continues to go sideways. And then we have had the initial signal of a Hindenburg omen. We have until August 2nd to see if we're going to get a confirmation of that. And we have not received a recent signal with the NASDAQ Hindenburg omen. Seasonality, have a bunch of different charts to show you. This red area, this shows that the first part of July is strong, and then we hit a period of seasonal weakness, which may be what we're going through right now. July does tend to perform well when we go back on a monthly basis to 1950. And then we look globally, where July is one of the better performing months on a global basis. And then June was positive. July has been good up until the last few days. And then August tends to do well during an election year. But we're wondering, are we getting kind of far away where we were going? We were getting way above all of these different seasonal tendencies that usually happen, which we're also seeing here, where June, July, where even when we get into July, we do see some weakness throughout the month without things necessarily falling apart. Also, during an election year, we tend to see some pretty good chop right about now, which is kind of what we're going through. And then comparing what's happening with 2012, we're coming into July now, where it can be pretty choppy during this time, and that's what we're seeing. And then taking the 3 months, here's June, July, and August from 1928 to the present, when you're in the 4th year of a presidential cycle. Then looking at the past 20 years, where the last 10 years have been the most positive, past 20 years are in blue, and then during an election year, that actually ends up performing the worst. 1950, that's a kind of yellowish area there. They're all positive, though. And then we tend to see a lot more chop during a presidential election year, and this might be because of the different conventions. We had the Republican National Convention, and then in August will be the Democratic National Convention. And then the first part of July tends to be strong, where the second half, it's positive, but not very strong. This shows that same thing. The first half of July tends to be the best part of the year, going back to 1950, where the second half is just kind of so-so. Then keeping a longer term perspective, June, July, and August, even though we don't go straight up, it tends to be more positive on a seasonal basis here. And you can flip a coin for July. We're up 9 times, we're down 9 times. That's 50%, with an average return of 0.7% for the election year going back to 1950. And then just showing where we see strength here from 2003 to 2023, both with the NASDAQ and with the S&P. So thank you. I really hope you found this helpful. I hope you're having a really nice weekend, and I will talk to you in the next video.